I wrote a little note, I write a weekly note, and then one of the things that I always looking at is that when markets move, everybody says, oh, the bond market's doing this because people think this about inflation or they think this about growth. And actually, most of the time, it's more esoteric than that. It's all about the hedging. So people might be buying bond, not because they believe anything about the economy, but because they've got somewhere else on a balance sheet, they've got to set it off. Now, it's quite detailed here, but really the point is that for the last couple of years, the biggest buyer of mortgage-backed securities has been the Fed. It's been part of the quantitative easing. Now, the thing is, in the old days, when people bought mortgage-backed securities, they're a bit weird because when interest rates go down, normally bond values go up. But of course, in a mortgage-backed security, you're more likely to get your mortgage redeemed. So therefore, you have to try and hedge against that. So in the old days, people would hedge their mortgage-backed security book by effectively buying more bonds when interest rates went down.
Interesting.
But the Fed's been buying them. They don't do that.
Right.
Now, the thing is that when you've got traditional buyers, what that means is the bond yields are a bit higher and they're a lot more volatile than they otherwise would be. So we've had much less volatility and lower bond yields because the Fed's been buying the mortgage-backed securities.
Right.
Now, they're going to stop doing that from this month onwards. They're not going to be rolling over. So what you're saying is nothing to do with the economy, but we start to go back to the old days of a higher risk premium in traditional fixed income just because of this big mortgage-backed security book. So the point I was trying to make to my kind of clients and readers generally is that we are going to see some consequences of the unwinding of QE in slightly weird places. And we've got to go and re-engineer all our models. Because in the old days, we understood that. But we've kind of forgotten about it because the volatility has gone away because the Fed effectively has been giving us free options and doing our hedging for us.
Right.
It sounds like things, the math doesn't work according to the formula. So we might see a suppression, perhaps, of rates rather than a natural ascension of interest rates because of what you're talking about.
Well, it's more the fact that actually everything has been kept less volatile and lower. Bonds are higher, bond yields are lower than they otherwise would have been because it was the Fed was the buyer, and they don't need to hedge. Most people who own any sort of fixed income security, they're matching assets and liabilities. They're not predicting the economy, and that's one of the things when you go into multi-asset is people say, oh, bonds are doing this, therefore that means the market's forecasting inflation, therefore I need to buy commodities or I need to buy cyclical equities. That isn't what the bond market is telling you most of the time. It's telling you they're hedging their assets and liabilities, and that's creating that they're balancing their books over there. It's all about the market itself. So one of the underlying principles of what I talked about over the last 25 years is that when markets move, first off, say what internal in the market is driving that, as opposed to thinking it's giving us some great insight into GDP or inflation or the economy, which is the default that we do on shows like this. We say, oh, the market says this about inflation. Maybe it's not. Maybe it's saying there's a different buyer.